Have you ever looked at your corporation's bank balance and thought, I should be doing something smarter with this money, but you weren't sure what? You're not alone. Many Canadian entrepreneurs build up hundreds of thousands and sometimes millions in retained earnings that just sit there. Why? Because pulling out that money triggers a tax hit. Today, I want to share Mark's story. He's a successful Ontario entrepreneur who faced that exact problem and found a way to turn $300,000 to $400,000 in annual retained earnings into a flexible pool of opportunity capital. Mark had built a thriving creative business, generating about $750,000 in net income in each year. He and his wife paid themselves reasonable dividends, but year after year, hundreds of thousands stayed trapped in his holding company. Over time, his retained earnings grew to more than $1.5 million, mostly in low-yield accounts and ETFs. He told us, I didn't want to pull it out and lose almost half of it to taxes, but I hated seeing it just sit there and do nothing, and when I did invest it, I was paying 50% in passive income taxes. That's a familiar tension for many entrepreneurs. The money feels safe, but stagnant. Here's the reality. When profits are left inside your corporation, they're initially taxed at a lower corporate rate. That's great, but once you take them out personally, they get taxed again. Or really what it is they're getting taxed at a higher rate, sometimes at 45% or even more. So what do? You keep it inside. You defer those taxes. And unfortunately, that cash can actually lose purchasing power to inflation. Of course, if we invest it and earn passive income, we can also be losing about half of that upside. So while you might keep up with inflation, you're going to be giving away quite a bit in taxes. This is the corporate cash trap. Money that's too expensive to withdraw, but too inefficient to sit idle. When Mark revisited the idea of a corporate-owned whole life insurance policy, something clicked. He realized it wasn't just an estate tool. Properly structured, it could serve as a living asset inside the corporation, a place where retained earnings could grow tax-advantaged, stay liquid, and even be used as collateral for opportunity financing. He told us, it's like my HELOC. It's dry powder, available when I need it, but working for me in the meantime. That shift from seeing insurance as an expense to seeing it as a strategy changed everything for Mark. Let's unpack what he did step by step. First, he set up a participating whole life insurance policy owned by his holding company. He committed to a base annual premium of about $115,000 with the flexibility to add more up to $300,000 if profit allowed. The policy was designed for early cash value, meaning it built accessible liquidity quickly. And as the cash value grew, he could borrow against it directly from the insurer or using a third-party lender like a typical Big Five bank to fund investments or other opportunities. Here's why that matters. The cash value inside the policy grows tax-deferred. Loans against it don't trigger personal or corporate tax, and they can actually be written off if they're used for investments. And here's the kicker. The death benefit will eventually replenish what's borrowed and much more tax-free for their heirs. So instead of leaving retained earnings stuck in a savings account, Mark effectively turned them into a private wealth reservoir that compounds in the background. Now, don't get me wrong, Mark didn't rush into this. He coordinated with his accountant, ensured the corporate ownership was structured properly with me and my team, and he treated this as a strategic allocation, not a replacement for market investment or any other type of growth investment. And what stood out was the emotional change. He said, this isn't about insurance, it's about flexibility. I finally feel like I can use my money on my own terms. That's what this approach offers, clarity and control. It bridges the gap between liquidity and long-term planning. Today, Mark's policy has already begun accumulating a significant amount of cash value. His corporation continues to earn strong income, and instead of much of that sitting in idle cash, 30 to 40% each year, his surplus now flows into a policy and a strategy that keeps the funds available within days for opportunities, reduces long-term tax drag, and builds an estate benefit that will one day pass on to his family tax-free. The outcome, financial flexibility and peace of mind. So what can you take from Mark's journey? If you're sitting on a significant amount of retained earnings and you want to make that money work for you without losing liquidity or facing heavy tax bills, this approach might be worth exploring. Because wealth isn't just about accumulation, it's about control. If this resonates with you, we'd love to help you explore your options. You should first head over to CanadianWealthSecrets.com/pathways in order to get a sense of where you are along the 4 stages of personal and corporate tax wealth building. Now, if that story resonates with you, we'd love to help you, your family, and your business by booking a discovery call over at CanadianWealthSecrets.com/discovery. You can also head over to our Pathways page, which will allow you to take a very short assessment that will take you through 4 stages of wealth building so that you can understand where things are strong and where you can focus your attention next. So, my name's Kyle Pierce from Canadian Wealth Secrets, and I look forward to seeing you in our next episode. Now, just as a reminder, this is not investment advice. It is for entertainment and education purposes only. Should not construe any such information or other material as legal, tax, investment, accounting, financial, or other advice. And Kyle Pierce is a life licensed and accident and sickness insurance agent and the president of Canadian Wealth Secrets Incorporated.